Welcome to the continuation of our lessons. Today we're going to take a look at business units part 3. Before we can get started, I would like to make mention that Bluegum is now on Pathfinder. So Pathfinder is a new app that you can use to find top tutors in Zambia. There are tutors for almost all the subjects that you want, both online and offline tutors. You can find it on Google Play. With that, let's continue. So far, we have looked at introduction, we have looked at sole trade, we have looked at partnership, we have looked at private limited companies. This is where we ended on private limited companies. In today's video, we're going to take a look at public limited companies and multinational companies. We're also going to take a look at public enterprise. Then in the next and last video on business units, we are going to discuss capital of a. Okay, so what is a public limited company? Just from what you have learned, you can have an idea of what a public limited company is. Okay, where from in the previous video we talked of a private limited company. Okay, we know what private means, we know what limited means, and of course when we did sole trade and partnership, we talked about unlimited, right? So a public limited company is a corporate association of at least 2 persons which is registered with the Register of Companies and owned by shareholders who have limited liability. Okay, so just to go a bit deep, okay, let's just break apart the words that make up public limited. Okay, what does public mean? Public means that the general public are welcome to buy shares in the company. Well, limited means the liability of the company is limited to its total resources. Okay, so the first one, public, it means you and I can buy shares and become shareholders in that company. Okay, it's not just for some specific people like private limited company. Okay, then limited means the ability of the company is, the liability of the company is limited to its total resources. Okay, this is the same as in private limited company. This is where now the difference between sole trader and partnership can be seen from private limited companies and public limited companies. Okay, so for a sole trader and partnership, they have unlimited liability. Okay, meaning that if the business is in trouble, the owner has to sort that trouble. Okay, if the business is in debt and it cannot pay back the money, the owner has to pay the money. Okay, but for a private limited company or a public limited company, the owner has nothing to do with such. Okay, if the business is in trouble, the business has to find a way to sort out its issues. Okay, so that's what it means. So the liability of the company is limited to its total resources. Okay, another way we can say it is the liabilities or debts of shareholders are confined or restricted to the amount of capital or money they have invested or put in or agreed to pay in. So when they started the company or when shareholders bought shares, the amount they invested in the company, that's the only amount that's going to be affected in case the company is in trouble. Okay, let's take a look at features or characteristics of a public limited company. So membership is from 2 shareholders and no maximum. So it cannot be formed by 1 person. It has to be 2 people. Okay, but the maximum number of people, there is no maximum. It can be 100 people, it can be 1,000 people, it can be 2 billion people. okay, but the minimum number should be 2. It can't be 1. It has to be 2 or more than 2. Okay. Also, shareholders have limited liability. Also, shareholders are the owners of the company. Okay, so that's another feature there. Another feature is it is registered with the register of companies, just like private limited company. Also, its cap is raised through the sales of shares. Okay, remember how a private limited company is formed. Okay, so when two people come together, they decide to have this company. They have to come up with shares to sell to the shareholders. Once you buy the shares, then you have invested in that company, and that investment is what is used as the capital for the company. Just like a private limited company, a public limited company also holds annual general meeting. So a public limited company also holds annual general meeting. So another feature is it is controlled by the board of directors elected by fellow shares, by fellow shareholders at the annual general meeting. Okay, so just like in private limited companies, public limited companies also they are controlled by the board of directors who are chosen by fellow shareholders at the annual general meeting. Okay. Also, there is continuity of existence even after the death of important shareholders, unlike partnership and sole trade, where if one person dies in sole trade, the business dies, or if both partners die in partnership, even one partner dies, the business, of course, there will be no continuity. So for public limited company, there's always continuity even if important people die. Also, it has a separate legal status. The shareholders and the company, when it comes to the legal affairs, they are separate. Okay, if the company is about to be sued, the owners are not going to be sued. They are separate. Okay, so the letter PLC is written after the company name. So public limited company, they have the letters PLC, or private limited companies have got LTD. Okay, so when you see a company that has PLC, no, it's a public limited company. Well, the one that has LTD, it's a private limited company. So shares are sold at stock exchange. In Zambia, we use the Lusaka Stock Exchange. Okay, so if you want to go and buy shares in a company that has PLC at the end, you go to the Lusaka Stock Exchange. Also, shares are transferable, meaning that you can transfer them from one shareholder to the other. Financial records are filed. Financial records are filed with the register of companies. Okay, so all financial records are supposed to be submitted to the register of the companies. Okay. Shares sold to the general public. So shares are sold to the general public. Okay, you and I can buy the shares. So all these things I've already talked about them. So now let's look. We have looked at all the features, right? Now, what are the advantages and disadvantages from these features? Okay, there should be advantages and disadvantages. So we start with advantages from what we have already discussed, just trying to see what can be seen to be an advantage and what can be seen to be a disadvantage. Okay, so the first advantage is all shareholders have limited liability, which is good for a shareholder. Okay, they're not going to be in trouble when the company is in trouble. There is also continuity of existence even after the death of important shareholders. It has a separate legal status from the promoters or the shareholders. It has more capital because of more shareholders, and it has more borrowing capacity compared to partnership. Borrowing capacity is the amount of money a company can borrow. Okay, so because there's a lot of money, a lot of investment, so even people, the lenders who give out money, they are going to trust that they are going to get back their money. Okay, so the borrowing capacity is huge. Okay, even the capital is huge because there are a lot of people who can invest, unlike partnership, which has 2 people, or sole trade, which has 1 person. Also, more capital is raised through the sales of shares. Okay, if maybe they want to get a new machine, this company wants to get a new machine, but they don't have enough capital to get that. Okay, so they can sell shares and they can have more capital. Also, shares are sold to the public, hence more capital. Since the public is made of a lot of people, so when the company sells shares to the public, a lot of people can buy, and therefore more capital. Private, they don't sell to the public, so it can be just selling to your cousin, to your grandma, to people who are close to you, or to your friends. So it's not anyone who has the chance to buy shares in a private limited company. Well, public limited companies is the general public. Anyone can buy shares. Therefore, there's a big chance of getting a good capital. Shares are freely transferable. What about disadvantages? So the first disadvantage is there are more formalities in running a company, such as holding annual general meeting, as compared to partnership or sole trade. Okay, so for a public limited company, it's by law that they should have an AGM. AGM is annual general meeting. Okay, so all this has to be done. Even when you don't feel like it has to be done, it has to be done. So there are more formalities, hence it's a bit more complicated as compared to partnership or sole trade. If it's partnership, you're with your friend, you can just say, we were supposed to have that meeting, but we haven't made sales, so there's no need. Okay, we're going to have it when maybe we make sales. Okay, so it's a disadvantage, this one. Another one, there are more formalities in forming a company as compared to partnerships, such as formulating a memorandum of association and that of association. So there are lots of documentation that have to be done for you to have a public limited company. Okay. Again, it is more expensive to set up as compared to a sole trade. It's a big company, so it's very expensive. Another disadvantage is it is not flexible as compared to sole trade, as it is governed by 2 documents drawn up when it is registered as a company. So sole trade, there is no documentation. You do whatever you want, but a public limited company is controlled by documents, just like a private limited company. So this is a disadvantage. It is taken over if another company buys 51% of its shares. So if shares are available, then another company decides to buy more than 50%, that is 51%, then that company, the one that has sold the shares, will be taken over by the company that has bought the shares, even if they don't like to work with that company. Okay. There is little secrecy, as its accounts must be published annually. So there's no secrets. There are no secrets. All accounts are supposed to be published. Why is this so? It's because people, the general public, are going to buy shares, so they have to know if the company is making profit or not. Otherwise, the company may be lying that it's making profit so that people buy shares. Okay, so there is little secrecy. What about similarities between public and private limited companies? Okay, so both are registered with the register of companies. They can be formed by a minimum of 2 people and have no maximum. Shareholders have limited liability. They have separate legal status. The shareholders and the promoters have separate legal status from the company. They are both controlled by the board of directors. Capital in both is raised through a sale of shares. They are legally required to hold an AGM, annual general meeting. They are required to prepare the memorandum of association and article of association prior to registration. They are owned by shareholders with limited liabilities. Also, there is an assurance of maximum continuity of existence, meaning that they can exist for a long time as compared to a sole trade or a a partnership. So these are the similarities between public and private limited companies. Okay, so now what about the differences? Are there differences between a public limited company and a private limited company? So here are the differences. The first is private limited companies shares are sold privately to friends, relatives, while public limited companies they are sold to the public. Okay. The second is in private limited companies, shares are not offered for sale on stock exchange. Well, in public limited companies, shares are freely offered for sale on stock exchange. The third is private limited companies have the name ending with LTD, while public limited companies have the names that end with PLC. Okay, another difference is for private limited companies, financial records are not published to the public, while for public financial accounts are published to the general public. Another difference is private limited companies, they start the business immediately it is incorporated, while public, they have to start business after receiving a certificate of trading. So private, they don't receive this certificate, while public, they have to receive this certificate. And that's some differences. Private limited companies, their shares are not freely transferable. Well, in public limited companies, shares are freely transferable. To end today's lesson, we're going to look at multinational companies. Actually, we're going to look at multinational companies, then we also look at public enterprise. So what are multinational companies? So this is a company that is based on one country but operates factories, sales office in other countries. So the company can be a Zambian company, but its factories, offices, sales offices and others are in Malawi. Okay, so such a company is called a public limited company. Okay, examples include Total, okay, Total Energy, Shoprite. Okay, Shoprite is a South African company, but they are in Zambia, I think even Congo DRC. Okay, Bata Shoe Company, Coca-Cola, Yango, I've heard that it's a Russian company, but it's in Zambia. So these are examples of multinational companies. Okay, so they are also public and also private, okay, depending on the situation. Okay, so they can be both public and private. So what are the advantages of multinational companies? Okay, so they have worldwide contacts with the host country, which the host country can use to boost its export sales. What does it mean? Since they are coming from a different country operating in a host country, okay, for example, Zambia and Malawi, the way I gave, Zambia will be where they're coming from, the host country will be Malawi, where they're actually operating. Okay, so because they're coming from Zambia, so they have got good networks, so they can export goods to Zambia, and in the process, they can help in boosting Malawi, the economy for Malawi. Okay. Second, they pay tax, which boosts the government's income. Okay. In Zambia, we have, I think, we have some multinational companies from the mines, so they pay tax, which boosts the government's income. They also provide jobs around the world, especially in the host country as well. Okay, since they are creating, they have a company, so they create employment in that country. They also bring business knowledge, skills, and technology with them. Okay, so because they're coming from, from a different country, which may be a bit advanced, so they bring knowledge, skills, how to do things, the technology, machinery, okay, which is good for the country. They bring foreign exchange by selling their goods abroad. Okay, they provide quality and service to private householders as well as other companies. So if local companies are not able to provide the needed quality, then they end up bringing quality and service to these to the people who need them or companies that need those services and qualities. What are the disadvantages? So the first disadvantage is they tend to exploit undeveloped economies through practices such as reducing the price lower than the local traders. What does this mean? So what they do is, for example, they can come to Zambia. They see that Amaketobi is selling tomato at Tukwacha for tomatoes. So to get Amaketobi's business, they're going to also start selling tomato, but instead of selling at Tukwacha 4, they'll be selling Tukwacha 10 tomatoes. Okay, they won't be making profit, but the idea is to make sure that Amaketobi stops selling tomatoes because people will be going to this foreign company. Okay, and because of that, Amaketobi is going to be out of the business. Then once Amaketobi is out of the business, they are going to increase the price for tomato. A good example is what happened between Yango and Ulendo. Before Yango came, there was Ulendo in Zambia. So when Yango came, Yango was cheaper than Ulendo. So they made sure that Ulendo, people moved from Ulendo to Yango. Okay, so that's what they do. So they will reduce the prices so as to get business from local businesses. They also dominate most export market and force the small local companies out of business or take over the local firms. Okay, since they have got good networks outside the country, so they're going to become the biggest business in exporting, and they are going to dominate. Okay, so these local businesses are going to be they can either give up or they can take them as their own companies. They usually bring their own experts instead of training the locals to participate in important decision making. So instead of training the locals to become good at something, they'll bring people already good. Okay, so that is not good because the local people are always going to be below those trained experts. They are also able to pay high salaries and offer better conditions to attract most of the skilled local people at the expense of the local industries. So if there are two companies, okay, then for example, let's say in Zambia we have one company that runs trains, Zambia Railways. So if there's another company that comes to run trains, they can get those people who are good from Zambia Railways. Then in the process, those skilled people from Zambia Railways will go to the foreign company and they're going to be paid good salaries. In the process, Zambia Railways will lose the skilled labor. Remittance of their profits are taken back home, hence draining the host country's foreign exchange reserves. So as they make profit, instead of leaving this profit inside the country they are working in, they're going to take this money back to their countries. In the process, they're starving the country. Finally, they are centrally controlled and do not take into account the conditions in most countries when drawing up their policies. So when they are making policies, from where they are coming from, whatever they are going to plan, they will try to implement it, to force it in their home country because they don't take into account of the condition. Maybe things are difficult in this country, maybe there's no electricity in this country, so people are supposed to be maybe to be paid even if they're not working because there's no electricity. No, they don't do that. So they don't take into consideration the condition of the host country. They will just make policies wherever they are made at their headquarters, then they would want to implement them even if those policies are not good for the people in this given country. So we look at the last part. I need some water. My voice is almost going. Okay, so look at we discussed the last part, public enterprise. So it's going to be very short where we are done. Okay, So a public enterprise, also called a public corporation, is a business organization set up by the Act of Parliament to run and control a nationalized industry. A nationalized industry is an industry that belongs to the nation. Okay, so such a company is called a public enterprise or a public corporation. Examples include ZESCO, ZISC. Okay, so these are public corporations or public enterprises. All right, so what are the features of public enterprises? Okay. So the first is they are owned by government on behalf of the country. Second is the purpose is to provide members of the public with goods and services at a reasonable price. Okay, by reasonable price, it means price that people can afford, the citizens of the country can afford. Okay, its capital is provided by the government in form of what are called grants. Okay, there is no sale of shares. There is no situation where people put money like in sole trade or partnership. Okay, so the capital is provided by the government in form of grants. It is controlled by the board of directors who are appointed by the minister in charge of the ministry under which the corporation falls. Okay, so for example, ZESCO, it has to be the board of directors to be appointed by the minister who is in charge of energy. Okay, that's how it works. Profits are made by the public corporation. Profits made by the public corporation are used for. So the profits that are made, what are they used for? So they can be used to improve infrastructure in the country, such as buildings, schools, roads. Okay, they can also some can also be retained in business for repairing the machines, buy more goods for resale, etc. Okay. Some are used to repay the loans, since it's a company, so it can get loans, and the profits can be used to pay the loans. Another feature is its working is investigated through a selected committee. So there's always a committee that does the audit and just to see how the company is working, so that people are not just getting money for nothing. Okay, so what are some of the advantages of public enterprise? So profits made are used to develop the country by constructing roads, schools, and hospitals. It provides secure employment to a number of the country's citizens. Okay, the country cannot just be relying on the private sector. There is also a public sector which makes sure that there is always employment. Okay, it is able to serve the public even in remote areas of the country. So where people, where companies that are looking for profit, such as the private limited companies and the public limited companies, cannot go to offer services, maybe in remote areas, maybe the private companies and public companies are not set up hospitals or clinics to make profit there. The public enterprise can do that. There's a large scale of production, as government can raise any money or capital required for investment. It can also help the government to implement the policies, e.g. maintaining low prices. Okay, so if the government wants to maintain low prices because the situation in the country is low, the public enterprise can help to do that. Also, it is big, hence enjoys the economies of scale that results in cheap goods and services being offered to the general public. So what are economies of scale? So economies of scale is where you produce or order things in bulk. When you do that, even if you are selling at low prices, making small profits, at the end of the day, you end up making a lot of profits. Okay, if you can make a 50 ngwe profit from the sale of one bread, and if you produce 2 million breads, then it's 50 ngwe times 2 million, which is a lot of money. It is also a source of income to the government and may therefore reduce the tax, such as pay as you earn. So when you are working, when you get paid, you have to pay tax to the government. So if the government has money, they may say, okay, we won't be getting too much from you, so they are going to reduce the pay as you, the tax. In this case, and in this example, the tax that is called pay as you earn. Okay, we almost done. We look at disadvantages. So disadvantages include there is too much bureaucracy and red tape in decision making. Okay, that mentality of the boss has said this, the boss has said this. Okay, So that's the one of the disadvantages. Also, taxpayers pay losses made in the public corporation. So if ZESCO has made a loss, the money that is going to be used to cover that loss will come from taxpayers. So the government may even increase the amount of tax that you're supposed to pay as a citizen, so as to cover those losses. There's also the I don't care attitude of workers, which contribute to the inefficient and poor performance of public corporation. So the thing with public corporation is, so long as you're going to work, even if you're not working, even if things are bad, so long as you are getting paid. So because of that mentality, there is no efficient, people are not producing. So the performance of a public corporation is most of the times affected negatively by the I don't care attitude of workers. Also, there is political interference which may adversely affect its performance. Okay, for example, it can be a situation where there's maybe election approaching. So for the government of the day to come out as if they are doing good for the people, they may force a company to reduce the prices such that it starts operating on a loss. Okay. Also, workers usually have no self-interest to perform duties efficiently, and it leads to poor service and goods offered to the public. So, like I mentioned in the I don't care attitude of workers, yeah. So workers, they don't have interest to work; they just work because they have to. Okay, so that's another disadvantage there. Also, it is very expensive to run. Okay, the last part is where we compare the difference between public limited company and public corporation. Hope you'll be able to see. Otherwise, just follow my voice. So for a public limited company, it is formed by a minimum of 2 shareholders with no maximum. Well, a public corporation is set up by the Act of Parliament. There's nothing like number of people or people coming together to form a company. Okay, it is owned by shareholders. Public limited company, well, a public corporation is owned by the government. A public limited company, its motive is to make profit. That's what it wants. Well, a public corporation, its motive is to provide goods and services at reasonable price to the citizens. Okay, a public limited company, capital is raised through the sales of shares to the public. Okay, well, for a public corporation, capital is raised through government grants. Okay. Another difference is the board of directors are elected by shareholders. Well, for a public corporation, the board of directors are appointed by the minister. Okay. Another difference is for a public limited company, its working is controlled by the board of directors. Well, for a public corporation, its working is investigated by the parliament through the selected committees. So I'm not going deep to explain these details because we have talked about them. We're just now comparing. Okay. Finally, profits made are distributed to shareholders as dividends. Profits made are distributed to shareholders as dividends. Well, for public corporation, profits made are used for improvement of the infrastructure in the country. So these are the differences between public limited company and public corporation. So I'm sure this marks the end of this part. Next, we're going to finish business units. See you in the next lesson.